Hey guys, welcome back to our 15-minute tax-savvy small business live. Today we are talking about something that sounds super exciting and sometimes it is, but also sometimes causes very expensive mistakes. We are talking about cost segregation. If you have been anywhere near real estate investing circles, you've been probably heard something like bought a property and wrote off $200,000 in 1 year. And everyone gets excited. Huge deduction, massive tax savings. Sounds like a magic, right? Here is the part no one explains. Cost segregation is not free money. It's timing. And timing without strategy can hurt. So let's break this down in easy human language. When you buy a rental property, the IRS says you normally depreciate it over 27 and a half years if it's residential. That means you slowly deduct the building value a little bit each year. Cost segregation is basically a study that breaks the property into small pieces. Instead of depreciating everything over 27 and a half years, it identifies parts of the property that can be depreciated faster over 5 years, 7 years, 15 years. Things like flooring, cabinets, certain wiring, parking lots, landscape. And when you accelerate those pieces, you can take a much bigger deduction upfront. Especially bonus depreciation is allowed, and it is allowed in 2026, by the way. Now, I want you to pause with me for a second because this is where investors emotionally get excited. They see the big number, they imagine paying less tax this year, they imagine keeping more cash, and sometimes that is exactly the right move, but sometimes it's absolutely not. So when does cost segregation make sense? It makes sense when you actually have taxable income to offset. If you are a high income earner or your real estate is generating strong profit, or you qualify as a real estate professional and can use the losses against active income, then accelerating your depreciation can be very powerful. It can create real cash relief right now. It can also make sense if you're in a very high tax bracket today and you expect to be in a lower tax bracket later. In that case, taking deductions now at a higher tax rate is a smart strategy. But here's when it doesn't make sense. If your income is already low and the losses are just going to sit there suspended because of passive activity rules, then the huge write-off might not benefit you today at all. Or if you plan to sell the property in just a few years and no one told you the depreciation must be recaptured, that upfront savings can come back as a big tax bill later. Also not ideal. And this is the part that people skip. When you accelerate depreciation, you are front loading deductions. When you sell, the IRS says, great, now we are recapturing that depreciation. That means part of your gain gets taxed differently. It doesn't mean cost segregation is bad. It just means it's timing strategy. You need to understand the full movie, not just the first scene. Another big misconception I hear all the time is that cost segregation is only for massive apartment complexes. Okay, looks like I'm back. I hope you heard me. I'm not sure where you might have stopped hearing me or where my stream got interrupted, but I will just continue where I have stopped. So, if you ever jump into something because another investor said, my CPA did this and I said a fortune, I want you to hear this. The situation, his situation, is not your situation. Tax planning is very personal. Your income, your goals, your exit plan, your lifestyle, your stress tolerance, all of it matters. So here is what I did for you. I created a cost segregation clarity worksheet that walks you through the right questions to ask before you do a study. It helps you think about your income level, how long you plan to hold the property, whether you qualify for real estate professional status, and what your future tax brackets might look like. Even if you're watching it on replay, you can grab it, go through it. It will help you think strategically instead of emotionally. Because cost segregation done right can create serious cash flow and serious momentum. Cost segregation done without a plan can create confusion, recapture surprises, and regret. And I don't want that for you. We are not here to chase flashy write-offs. We are here to legally pay as little in taxes as possible over your lifetime, not just this year. If you're wondering whether it makes sense for you, for your property, please reach out. We can actually model it. We can look at now versus later. We can look at hold period. We can look at tax brackets. That's when it becomes powerful. All right, that's it for today. If this was helpful, please share it with another investor who has been hearing the hype but hasn't heard the full picture. Next week, we will keep building on a real estate strategy because this is where so many small business owners building wealth and also accidentally overpay. See you next time. Have a great week.